I want to share with you guys a research study that was published in 1973 from the University of Princeton by Professor Burton Malkiel. He suggested that he could find a group of blindfolded monkeys that would throw darts at the pages of a financial newspaper, and those monkeys could randomly select a portfolio that would perform just as well as one carefully selected by experts. Of course, he was wrong, because the monkeys didn't do as well as the experts. They did better than the experts. I always had these questions when I started investing, like where do you look to find good stocks to buy and what do you look for? And all of the videos that I found on YouTube and Google, none of them explained to me. And maybe it's because I'm dumb, but I don't understand any of that stuff because they don't explain it step by step. And most importantly, they didn't explain the reasoning behind why they did what they did. So in today's video, I want to teach investing like I would to my younger self. This is information I really wish I had known when I was younger, because maybe that way I would have built myself a six-figure portfolio a little bit earlier rather than 26. Maybe I would have gotten there by 24. You don't know what could have happened, but I do know that I was getting paid roughly $40,000 a year at the time when building it. So with that said, guys, I have nothing at the end to sell you, so smash that like button and let's begin. Happy Friday, frugal people. My name is Andre Jick, and in today's video, I want to encourage you not to listen to me. Reason number one, my shirt is too tight. Reason number two, it's because I've been very lucky in the last 5 years. Let me explain. I've made close to $40,000 in the stock market, along with $21,000 of dividends. And that's pretty impressive considering the fact that I started with just $0. But that's because I've been extremely lucky, not in finding individual stocks, but to have started when I did right before the beginning of a huge bull run. Chances are right now, if you guys just randomly throw a dart at a dartboard with stocks, you guys are gonna make money in the short term. And that's precisely why I wanna encourage you to be very cautious when trying to find individual stocks to pick. But the reason that I still pick individual stocks is because of something called index funds. There's one specific one from Vanguard called VTSAX. Right now, one share of VTSAX costs $74.55. And by owning one share, you will have spread out that $75 amongst 3,000 US publicly traded companies, along with exposure to the international market. And all you have to do is keep contributing and buying this fund every single month as much as you can afford. And when you're ready to retire, chances are, most likely, your index fund is going to beat my stock portfolio. That's just how it works. The reason that I still do this though is because it gives me a little bit more flexibility, and I've essentially recreated my own index fund that closely copies and replicates the performance of some of my favorite indexes. And it pays me monthly to just hold all of these stocks, and I can do all of that without collecting any fees. However, I don't want to use what success I found in the stock market as leverage to sell you on some course about how to be successful in the stock market. I think that would be very dishonest on my part, and I don't think I'm smarter than the average investor. But I still want you to be aware of the concepts that are behind finding good value in the stock market. And if you find somebody who's claiming with 100% certainty on how they found a strategy to be profitable, I want you to not just walk, but run in the opposite direction. Just not before smashing the like button on this video, please. To further discourage you from trying to find individual stocks, I want to share with you guys a research study that was published in 1973 from the University of Princeton by Professor Burton Malkiel. He suggested that he could find a group of blindfolded monkeys that would throw darts at the pages of a financial newspaper, and those monkeys could randomly select a portfolio that would perform just as well as one carefully selected by experts. Of course, he was wrong, because the monkeys didn't do as well as the experts. They did better than the experts. So they ran this theory dating all the way back to 1964 to the recent present. 100 monkeys throwing darts every single year. And what they found was that 98 out of 100 times the monkeys beat the experts. When I first heard about this, I couldn't believe it. And I thought to myself, where do I buy Stock Monkey? Unfortunately, I couldn't find these monkeys because they're not real. This is just a simulation program to simulate randomness against humans. But monkeys beat humans sounds way more clickbait, which is why I should have titled this video something like, "Are you smarter than a monkey?" That would have been a lot better. So the moral of the story is, don't go to a professional stock picker or fund manager and expect to get great results, because their job is to sign you up so that they can collect the fees and the commissions that they generate from you holding on to their fund. So now let me contradict myself for just a brief minute and show you how to pick the winners. That's dumb.
That's so cringe.
So I'm gonna take a look at 2 factors when helping to value a company. I'm also gonna provide all the websites and all the things that I use when looking at this data. So the number one thing, Andre, I'm referring to you as Andre. I know your name is not Andre. It's like you're my younger self. But if your name is Andre, I bet I freaked you out. So the number one thing I want you to understand is that anyone can make money in the stock market, and you don't have to be smart. You can indeed outsmart the monkeys. Here's how. When it comes to investing, smart money isn't as smart and dumb money isn't as dumb as it thinks. And it's only dumb when it listens to smart money. So the only real way to consistently make great money in the stock market is through long-term value investing. So, my 19-year-old Andre, I want you to forget just for a brief second with me, forget about all the other things you're trying to do right now, like short selling and day trading and penny stocks and options trading. Just forget about all that for a second and become a value investor with me for just a brief second. Okay, I have a question. What's up? What dat? Think of a coin, just like a coin that has 2 sides. On one side, there's something called quantitative analysis, and that's when an investor will look at the numbers of a company to determine its real value. When I say real value, I mean if you Google a company's stock price right now, and Google will show you whatever price it is, it's actually not its real price. That's more of an illusion or a mirage that's based upon rumors, news, and expectations. Quantitative analysis specifically will take a look at things like income statements and cash flows and balance sheets and net debt to equity ratios and other fancy financial terminology to determine its real value. Now, collectively, these words mean the fundamentals of a company. You can find these fundamentals by doing a simple Google search or just looking at a company's quarterly earnings reports. Personally, I use something called Simply Safe Dividends, which has been an amazing resource for finding inspiration, as well as looking into the data for looking at all these terms. But I will say this though, that they're extremely expensive. So if you're just starting investing, just be advised about that. But they do have a free 2-week trial where you can just sign up, provide an email, and you can get access to their services. After which point, you don't have to pay, and just maybe you can provide a new email. But you didn't hear this from me. There goes my non-existent sponsorship with them. If you guys want to learn more about how to do quantitative analysis, I highly suggest you guys pick up the book called The Intelligent Investor by Benjamin Graham. He goes into great depths explaining exactly how to do this, so I'll just leave a link in the description below this video. And the other half of this coin is something called qualitative analysis. Now this focuses less on the numbers and more so on the qualities that make something a great company. So for this one, I'll give you guys a personal example of a company that I'm considering purchasing right now based upon the price in relation to the quantitative analysis, which means right now the stock is trading lower than what the fair value is. So the company in question from my example is ExxonMobil. I'm considering buying some more because I bought this company 5 years ago at $93.88 per share, which right now it's trading at $72, and that means I lost $345 or 23%, which is insane. Why are you watching my videos? I'm an idiot. But I do know that the fair value of ExxonMobil should be closer to $83. And I know this because of a service I use called Morningstar. It's another premium service that rates stocks based on a 5-star system to determine if it's a cheap or an expensive stock to buy. Now, it's another premium service that's kind of expensive, so if you don't want to pay for it, another pro tip I can give you guys is if you go to your local library, you can actually use your library card and you can access the website's premium features for absolutely free. Don't know why, libraries are just awesome like that. So log in and check out the prices that way. Another place you guys will see this 5-star rating system, I just started doing this in my videos where I show you my dividend income, which stocks I bought, which stocks I sold, and it'll show you the 5-star rating system there too. Anyway, because of that quantitative analysis, I could say that if I bought it at $93 and I liked it then, I should love it at $72, right? That's correct, except I'm already very diversified into the energy sector. I own British Petroleum, Royal Dutch Shell, ExxonMobil, Chevron, and I don't really want any more energy sector companies. I don't know where oil is going to be in just a few years. Now I know they'll probably be around in 10 years, maybe even 15 years for pretty much sure, but are we going to go towards electrical and wind and solar and maybe fusion someday? Maybe in my lifetime, maybe not. I don't know, but I want to limit my exposure to any one sector to no more than 25%. Other qualitative analysis questions I could ask is this company boring? If yes, great, that's what we want. Another question is, do people have to keep buying this product over and over again? In ExxonMobil's case, yes, absolutely. People need oil all the time. In contrast to something like, say, a car company like Tesla, where Tesla has to find new customers every time when they want to buy their products. Because realistically, how often do we find and buy a car? A couple times in our life, and then that's it. That's a lot harder than when you're selling something like toothpaste or gum or shampoo or something like that, right? So if you guys want to learn more about qualitative analysis, I highly recommend you guys check out the book called One Up on Wall Street by Peter Lynch. I'll also leave a link in the description below the video. Here's the thing about this coin though, even if you intimately study both sides of it, the odds of you predicting which side it's going to land on is still going to be 50-50. So in addition to mastering both quantitative and qualitative analysis, I also want to be a diversified value investor, which means that I want to look for coins that are slightly bent or weighed in my favor. So over the long term, it'll flip in my favor. So when it comes to real estate investing, it's kind of the same thing where you buy a property that's heavily undervalued, you pay some money to fix it up, now it'll be worth more, and when you sell it, it's the difference between the two that's called the wedge deal, and that principle also exists in the stock market, and that's what we're gonna take advantage of. But stepping off that analogy for a second, what I specifically mean is that we're gonna take a look at both the qualitative and the quantitative analysis, and then also say, the price is really undervalued. If I buy this stock right now, that means I won't be necessarily guaranteed to make money right away, but I do know that I can't lose much more money based upon the value that I bought it at. And that difference between the two, when the reality catches up with the stock price, that's when we can make money, and that is the little wedge deal that exists in the stock market. In other words, the price to risk ratio is much more in my favor. If you guys want free inspirations on where to screen your stocks initially, I would highly suggest you guys look up the dividend investing community and start to follow people like Jason Fieber, Dividend Diplomats, and even David Fish's list of dividend champions that gets published each and every month. It's incredible. I'll leave a link in the description below the video. The only other thing I'll plug today is my Patreon page, where I include a dividend tracker, so when you plug your stocks in, everything gets automated and everything is updated. Try saying that 5 times fast. I can't thank you guys enough for all of your support. I also include my stock purchases as well as my dividend income reports. Everything is 100% transparent. Again, thank you guys so much. Love you all, and I'll see you all on Monday. Bye.